You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com. Gold, crude oil, corn, soybeans, and more. With so many tradable products, the futures options market can be an intimidating place. How can you possibly keep track of the latest trading developments across so many different products? Don't worry, we've got you covered. Welcome to This Week in Futures Options, the program designed to help active futures options traders stay on top of this ever-changing marketplace. Each week, we'll break down the top trades, hot products, volatility explosions, and much more. So be sure to check out our live stream via the Mixlr app, or join our live chat room at mixlr.com/options-insider. Whether you're an experienced veteran or a newcomer looking to separate the wheat from the lean hogs, This Week in Futures Options has the information you can't find anywhere else. This Week in Futures Options is brought to you by QuickStrike, options pricing and analysis software. Learn more about QuickStrike at bantix.com. This Week in Futures Options is also brought to you by CME Group, the world's leading and most diverse futures and options exchange. Visit cmegroup.com/options. This Week in Futures Options is also brought to you by FTSE Russell, a leading global provider of benchmarks, analytics, and data solutions. For more information, please visit ftserussell.com. And now, get ready to break down the latest futures options trading activity. It's time for This Week in Futures Options.
All right, everybody. That music means it's that time again. It's Thursday, 1:30 p.m. Central, 2:30 p.m. Eastern. That means it's time to talk some futures options. Yes, it is time for TWIFO. My name is Mark Longo from theoptionsinsider.com. You know the rest. You guys know how to find us. You guys know how to listen live. All that good stuff because you're here. You're listening to us. We appreciate it. Make sure you hit us up with your questions, your comments, your insights, your pearls of wisdom. We love hearing from all of you out there. We got a lot to get to on the show. And joining me to help me do just that, one of my favorite guests, holding down the CME Group hot seat, Mr. ERIK, NORLAND, the Executive Director and Senior Economist over there at CME. ERIK, welcome back to the program, sir. It has been too long.
Yes, thank you so much for having me back.
Yeah, it's been quite a while. I have to say, you always get the award from me, ERIK, for the most well-timed and best-named research out there. We'll get to some of that in a little bit. You have a flair for the titles. Shall we say. But you've been a busy fellow. It's been, I don't know, at least 4 or 5 months, maybe 6 months since we've had you on. You and Blue, the two of you, are kind of just, seem like you're cranking away at a new research report every other day. I don't know how you keep up that pace. So we have a lot to get to. But let's kick it off, actually, in an area that we don't really have a chance to dive into all that much on the show because there always isn't a lot going on here. Of course, I'm talking FX here. Let's kick things off. I know a lot of your recent research, ERIK, has been on. Oh, by the way, before I even keep going, cmegroup.com/TWIFO, TWIFO. That, of course, is the place where you guys can follow along with all the reports that ERIK and I are going to be discussing on the show here today. That's for the TWIFO reports. If you want to read the research itself, just go to cmegroup.com. And on the homepage, you'll see all the research right there. You can dive into it, see all the graphs and the charts for yourself. I encourage you to do that because there's a lot of great visuals that go along with these reports. ERIK and I are only going to have time to really kind of skim the surface of each of them. But let's start off in kind of a contentious area here. I'm talking Brexit here, ERIK, a lot going on. This is, of course, your neck of the woods now. You're dialing to us over there from the sunny UK, and of course the big vote coming up here on Brexit. And you have an interesting report that just came out saying the pound, set for some volatility coming up after a pretty calm summer. Why don't you walk us through what some of your interesting findings, some of your takeaways were in that report, sir?
Well, in the intro to your show, you mentioned the term structure of volatility.
I did.
And the British pound option right now has some of the most fascinating term structure that I think you'll ever see. Term structure is often fairly standard, right? Usually the at-the-money options for like 1 month trade for a little bit less than 2 months, 3 months. They usually have some positive slope, but the term structure for British pound options right now is pretty wild. It basically has this gigantic hump in it around October, and then it calms down after that. And of course, that has to do with the October 31st deadline that the United Kingdom has set with the European Union for exiting the EU. That combined with the fact that the UK is about to have a new prime minister who will almost certainly be Boris Johnson, who has said that exiting the European Union is a do or die issue for him and, most importantly, for his political party. And so basically what the options are saying is pretty simple. The options basically say a 1 month option, so covering from, say, July 18th to about August 18th or so, 30-day option. You get that at 6.2% implied volatility. A 60-day option, which of course goes from today up until about mid-September or so, that sells at 6.9% implied volatility, so 0.7% higher than the 30-day. But the 90-day, which gets deep into October, but not yet past that deadline, is up at 8.8% implied volatility. Now, that might not sound like a huge difference. So 6.2 for 30 days, 6.9 for 60 days, 8.8 for 90 days. But the way I look at it is this. Imagine that you have a 30-day option, for the next 30 days, that's 6.2%. Then imagine that you, for example, sold the 30-day option and bought a 60-day option. What that essentially gives you is it gives you a 1 month option in 1 month time, so from mid-August to mid-September. Or you could alternatively sell the 60-day option and buy a 90-day option, which gives you a 1 month option in 2 months' time. And from that, you can back out what the implied volatility is for different calendar months. And so essentially the markets think that in the next 1 month, so between now and August 18th or so, 6.2% implied volatility, which is very low. The markets think this is going to be very calm, very boring late July, early August for the pound. The next month, August 18 to September 18, 7.7% implied volatility. But then from September 18th to October 18th, 12.3%. So the market is essentially expecting that the pound is going to become roughly twice as volatile as we get into that late September, early October period. And that's even before you get to the October 31st, in which case the peak when volatility could be even substantially higher than that.
Yeah, I'm looking at your report right now as we're talking. And again, a lot of great visuals. Check it out for yourselves there at cmegroup.com. It's called Brexit Pound Set for Volatile Fall After a Calm Summer. And some interesting takeaways here, Eric. You kind of alluded to a little bit of this earlier, but our audience loves themselves a little bit of skew analysis. You do a ton of it over there, so I always like reading your skew research. There's interesting stuff coming up about crude skew in a little bit. But before we get to that, you were mentioning kind of the skew out here in the pound USD options, indicating maybe a little bit more downside to lurk in the near future beyond the summer, so into the fall. So not quite. Next couple of months, probably calm, a little quiet. Summertime tends to be. But then looking beyond that, beyond 3 months and out certainly into 6 months, you're seeing a little bit more bias, shall we say, to the downside. Not a ton. I don't want to scare anybody running for the exits, but interesting. But then I guess as an economist, you also like to compare data points and frames of reference. And when we compare it back to the go-go days of Brexit back in 2016, not quite as extreme to the downside. Is that a fair synopsis there, Eric?
Yes, that's right. So the markets are not quite as worried about extreme downside in the pound now as they were 3 years ago on the eve of the referendum. But the markets are pricing some growing downside on the pound, and particularly when you get into those options that are a little bit longer dated. So the 1 month options are showing a little bit of downward skew, but the 3 month options that are showing that when you start getting into that window where we're really coming up to that October 31 deadline, the downside skew does grow a bit. But it's just as you said, it's not at extreme levels. It's not even at the extreme levels that we saw this past December, much less what we saw a few years ago back in 2016.
Let's break it down a little bit here. We don't get a chance, like I said, to sink our teeth into FX all that often. If you're playing along on the home game, listeners, head on over to the drop down there, cmegroup.com/TWIFO, however you access the Quick Strike platform. Click on the FX majors and go to pound USD. We'll look out over there because you could do euro, but obviously pound USD much more central to the Brexit story. Coming into the showtime here, we're seeing those front futures at about 1 1/4. So kind of effectively unched off maybe 0.5% on the week, but again, not a ton of movement out there from the underlying perspective this week. Again, not surprising. The big vote is coming up, so you don't expect much to happen. It's kind of like leading into an earnings announcement on an equity. You don't expect much to happen maybe till the event actually happens. The vol kind of creeping up about 0.5 point, looks like pretty much across the term structure out here, which again is kind of what you'd expect leading into a decent amount of event risk. And then, once the event happens, unless it's a tremendous surprise, you should expect a lot of this vol to come crashing in to the downside. In terms of overall open interest, actually a pretty strong week, up nearly 15%. So a decent amount of action out here from OI growth out here in the pound USD. The biggest, and this kind of goes back to what you're referring to in terms of time frame here, Eric, the biggest action this week, about a quarter of the volume going up in this SEP contract here, 25.3%, with the biggest trade. Again, pound USD is not it's not a euro dollar. It's not doing 100,000 contracts at a clip here, listeners. But the biggest one here looks like the 1.28 calls out here in SEP, doing just about 1,000 contracts out there. So again, a little bit lighter, but still an interesting week. Most of that opening, so maybe a little bit of opening upside here to the old pound USD spread. Skews, same deal. It's like, let's look here over the past week to see how. Let's go all the way out to SEP because that's where the most volume was this week. This as opposed to something a little bit closer. And let's see. Actually, no, let's go a little bit closer because we have that vote coming up. So how about that? Let's mix it up. Let's split the difference. Let's go out to AUGs. Let's go a little bit past the vote, and let's see what we're seeing out here from a skew perspective. And it looks like it's pretty much unched. Calls and puts are pretty much the same level they were this time a week ago. We get into the nearer dated contracts that have about a week to go. We're seeing the calls getting a lot more life and the puts also getting a lot more life. So a little bit of a smile coming up. Both the calls and the puts rich to the at the money. 3% to the puts, about 2% to the calls. This is for the contract with a little bit more than a week to go. So again, reflecting maybe a little bit of uncertainty as to how this event is going to unfold. And then going all the way out to the active SEP contract, we're seeing again the calls looks like they're coming in a little bit. So they were about 1.5% cheap at the money. Now they're about 0.8%. So getting a little bit more lift, I should say. And then the puts pretty much unched from this time last week. Again, it's always fun to sink our teeth into a little bit of FX. Before we move out of FX, I know, Eric, you've also been busy, you and Blue and the team over there. Obviously, there's something, you may have heard of it, Eric. There's a little bit of a trade war going on. I'm not sure if you're familiar. And that has some far-reaching consequences, including into the FX arena. In particular, for us here, our domestic currency, a.k.a. the dollar, is kind of interesting. But, of course, the protracted trade war and what's going on with our economy is going to have some impact on that dollar. And you have an interesting report that just came out, Eric, called "If the Dollar Weakens, Who Benefits?" And you kind of walk through some interesting different scenarios of domestic policy, international policy, and how they may impact the dollar and who could be winning as a result. So walk our listeners through that really quickly. What were some of the interesting takeaways you found from that research, sir?
Yes, I think a few things. So first of all, there's a couple factors that lead me to think that the dollar might start becoming a weak currency over the course of the next several years. So first of all, expanding twin deficits. We have wider trade deficits, much wider budget deficit. Usually when those deficits widen out, within a couple of years, the dollar starts to weaken. Now, we haven't seen that yet because of the second factor, which is monetary policy. But even in spite of rising deficits, the dollar has broadly been a pretty strong currency for these last couple of years. That has a lot to do with the fact that the Fed was hiking rates and then keeping rates much higher than other central banks around the world. But as we know, the Fed is almost certainly, at least in the view of our Fed funds futures contract, going to cut interest rates at the end of July, and will probably follow it up with another cut maybe in September. And so with the Fed now cutting rates, monetary policy is not going to be pulling the dollar upward. Instead, it's going to be probably pulling the dollar back downward. And so the last thing is the growth differential. The U.S. economy has been growing quite a lot faster than economies in Europe and Japan in the last few years. But the U.S. economy, in a judgment of the fixed income market, looks like it's probably going to start slowing down. And we're starting to see some signs that the U.S. economy is moving towards a slowdown. So the dollar could go from being a strong currency to being a weak currency. So the question is, who benefits? And so I think that there's really four currencies out there that might benefit. One is, of course, the pound. As soon as the Brexit situation clears up one way or the other, the pound is a pretty undervalued currency. It's a strong candidate to rally. And the other three are currencies whose central banks probably can't ease monetary policy much further. So that would be the euro, the Swiss franc, and the Japanese yen. So if the dollar becomes a weak currency, those four currencies, the pound, the euro, the Swiss franc, and the yen, could potentially become the strong currencies.
Once I saw this next report you put together here, Eric, I realized I had to get you back on the show. So let's keep on rolling here into our next product category that we like to talk about quite a bit here on the old TWIFO program. This is crude oil. You guys love it. You eat it up. You always want more crude. By the way, all of you from writing in asking about FX, there you go. Got you a little bit of a taste of FX there at the top of the show. So you can stop bugging us for at least a couple of weeks. We'll probably have more coming up with Brexit. So stay tuned. Maybe a little bit more Brexit or a little bit more FX coming your way in the near future. Let's move on to crude, of course, coming into Showtime. Bit of a weird one. Weird day, weird week for crude. Coming into Showtime, we're seeing crude off about 5 handles, or about 8.5%. So we're back in the mid-50s again. Remember last show, Russell from Tab Group and I were kind of looking at the numbers and the skew and the vol and all saying it seems like it's pointing to not a lot of upside left to go for crude. It had moved up 3 to 5 handles, and it seemed like they weren't pricing in a lot more. In fact, maybe they were pricing in a little bit of a retreat to the downside. And we got that and then some this week. Again, off 5 handles, 8.5%, coming in right around the 55 handle into Showtime. So a far cry from that 60 handle we were north of just last show. And that's all in spite of some interesting events. This morning, Iran claiming they seized a tanker, a foreign tanker. We saw a little bit of a pop, but then that kind of went away pretty quickly. We also saw some interesting data coming from the EIA earlier this week, showing a larger than expected drawdown in crude stockpiles. So you think, maybe that would be a little bit of a bullish signal. But then they also had a larger than expected buildup in stockpiles of refined products. That combined to, they chose to focus on that rather than the crude stockpiles. And as a result, we're seeing interesting stuff there as a result. The refined builds, of course, may be showing less demand from the summer driving season than anticipated, and that, of course, is what the market seemed to cue off of as a result. But, Eric, you've been pretty active out here in the crude space in particular. You had a couple of interesting charts and analyses you did recently. The most recent one, we'll start with that. Then we'll get into the skew one in a little bit because I want to sink my teeth into that one as well. But recently you put out something which, again, seems kind of timely. This was about a month ago, but given the recent play out we've seen in the futures in crude, it seems pretty timely. You said oil, 3 signs of prices hitting a bottom. This was back again about a month ago, June 19th. This came out. You mentioned how we had seen a bit of a downturn in crude as a result. And then, of course, we saw a decent little rally after this report. So, Eric, once again, you get the award for the well-timed research here on the network, sir. Congratulations.
Well, thank you. I don't know if I deserve that reward, though. If I had to give that reward to not one person, but to a group of people, I would give it to the options traders themselves. I think that in that skew data that you mentioned, there's a lot of really, really powerful signals in that data. And so I think that even people who don't trade options, even people who only trade futures or in the spot market, they really should be paying attention to what the options markets are telling them, maybe just about psychology. But, the oil market has this incredible reverse psychology where, when the market gets too bearish and its put options become super expensive, oil often rallies. And that's what happened in June. It got, essentially to it was one of 4 times in the last decade that we've seen such extreme pricing, with out-of-the-money puts becoming incredibly expensive with respect to out-of-the-money calls. And sure enough, crude responded to that with a decent rally. It's still 9 big figures. 9 big figures going from 51 to 60 would be huge news in most markets. In crude, on the charts, it doesn't look that big, but it's still a pretty nice rally if you caught it.
No, yes, that was one. Everyone was waiting for that moment. Everyone was waiting for that turnaround. We had seen a bit of a downturn, a bit of a drawdown in crude for the better part of a few months. And then you're right, we got into that middle of that month, and it turned around. But you hit on something. And when I saw this report, this came out a couple of months ago, which shows how busy ERIK is. It takes us a couple of months of lead time to book him, listeners. But when I saw this report, I knew I wanted to have you back on because you dove in kind of exactly what you were talking about. Something that we've been talking about a lot on this show is kind of the nuances and the secrets lurking therein for the crude oil options skew. It's something we analyze a lot here on the program. And as you kind of mentioned, it's an interesting predictive tool. Your report from May of this year saying, actually, this wasn't a report. This was your off-the-chart show. This is where you and Blue are competing with me doing your own podcast. But we'll leave that to the side for now. And the title was Oil, Are Options Skews Reliable Price Indicators? I'm guessing from your recent comments you think they are. But walk us through a little bit of why you think skew, in particular in crude, is such a meaningful indicator.
Yeah, sure. Well, first of all, Mark, we can't compete with you, but you know that. But I just think it has a lot of use for traders. Whether they're trading futures and options or just futures. But essentially, what happens is this: is that when those put options become really, really expensive, out of the money puts become really expensive with respect to out of the money calls, usually in the next 3 months, crude oil stages a rally. We don't have a massive price history for crude oil options. Actually, Quick Strike has this data going back almost exactly 11 years, which is pretty solid. But we don't have it back to like the 1980s or something like that. But over these last 11 years, when you see extreme downside skewness or extremely negative risk reversal, in other words, often crude oil generates a pretty positive return over the next few months. Whereas when the skew is sort of more average or somewhat more positive, usually crude oil over the next few months starts to sell off. So it's actually a pretty useful contrary indicator. And that's even more true of products like ultra-low sulfur diesel and gasoline, where the relationship seems to be maybe even stronger than it is for crude oil.
Let's break down a little bit of that crude skew and see what we're seeing out here in the marketplace. Again, pull up that drop down if you're playing along on the home game and pull up energy and then WTI, and you'll be off to the races here. Listen, you'll see exactly what I was talking about earlier, off about 5 handles, about 8.5% on the week, hovering around that 55 handle yet again. Vol, as you might imagine, given what's been going on out there in the space and maybe a bit of a somewhat not unexpected in terms of a downturn. We saw that coming, but maybe the degree of it, 5 handles. 8.5%, that's pretty extreme. So all that vol coming back in, that's also to speak to what we were talking about last week on the show. The bid is to the puts. So moving back down into that put wing, breaking back down that 60 handle to the downside, that's going to inject some juice back into the marketplace. So all of that, a combo, that 1-2-3 punch leading into some vol coming roaring back here into the WTI options, going out even a little bit. So let's go about a month. So at least we have the front couple of weeks are more gamma than they are vol. But let's get out a month or so, and we're seeing 4 handles, 5 handles in terms of vol coming roaring back into these contracts. So pretty meaty vol movement to the upside. The big action this week coming in the set contract. It has exactly 28 days to go, 57.6. Usually you don't see crude and WTI this biased in 1 month. Usually it's like 40, 45%, maybe 50 if it's really active. Almost 58%, almost 60%. Coming in this one contract this week, which is kind of interesting. Let's parse and see what was going on out here. It looks like it was all put action to the downside. Again, and not exactly surprising given the extent of our downside move this week. The big one, remember, crude folks like their even money handles, and not even coming in at a 55 handle, coming in at 50. So very pessimistic. A lot of opening paper here on the 50 puts in September, going up 24,000 times this week, including almost half of that, almost 11,000 going up today, 8,500 yesterday, and the rest kind of scattered throughout the week. So again, the OI numbers are kind of hard to read because almost half the paper went up today, but still a lot of opening paper going up here on this 50 put strike. Maybe as they're starting to threaten the 55 handle, people say, wait a minute, 50 is the next stop. Look out below. Let's go down there. And that's maybe as a result why we're seeing so much paper today on that 50 strike. Number 2, hot on its heels, were the double puts. So again, nice little healthy put strip, 55 and the 50 puts, 16,000 of those. Again, the lion's share coming today, 7,000. 53 puts also doing some action, about 12,000 of those. Again, the lion's share about half, a little more than half, 6,300 coming today. And then let's see, we actually do have some calls on the list, not all puts, listeners. Number 4 are the 60 calls. So again, going back to that even number fixation, with about 11,000 of those, 6,000 of that going up today. And to round out our top 5 here, we've got a bit of a tie between the 58 calls and the 58 puts. So that 58 strike getting a little bit of love. Both with about 8,100 going up. Both have the lion's share, except for the calls. The calls, 4,500 went up yesterday, whereas the puts, the lion's share going up today, about 2,600 of those. So interesting stuff out here in crude oil land. Let me just scroll as we like to do to see if there's any aberrant longer-term paper lurking out here in the weeds. Sometimes there's some weird stuff going up. 45 puts, pretty active here in DEES, going up 7,000 times this week, so even beyond the 50 strike. 70 calls also getting a little bit of love out here in June of next year, 2020, about 4,000 of those 70 calls also going up. And if that's not long enough for you, DEES of 2021, all the way beyond 2020 out to 2021, 70 calls getting some love, 3,400 times as well. Looks like it's similar OI numbers or similar volume numbers to the June call. So maybe a bit of a roll from June to DEES of 2021, but that'd be a strange roll. June of 2020 to DEES of 2021. But again, we've seen stranger things here in the energy market. There's a lot to unpack. We have other product categories to get to. But before we move on, Erik, anything else catching your eye, catching your mind here in crude before we move on, sir?
Well, yeah, I think that just the geopolitical risk is really, really high right now in the Persian Gulf, and so it's kind of curious to me looking at these options prices that they're so neutral at the moment. The risk reversal is sort of about its average level for the last decade or so. The market really does not seem very concerned that any sort of hostilities are going to break out in the Persian Gulf. And there may, in fact, be good reasons for that. There's often tensions in the Persian Gulf, but there's very rarely actually wars, thankfully. But I would watch that situation pretty closely as the U.S.-Iran nuclear disagreements heat up and as Iran may attempt to interfere with shipping through the Strait of Hormuz. I think that there's maybe a little more upside potential there than what the markets are pricing.
Yeah, the markets are kind of shrugging all this off to a very impressive degree. We kind of commented on that last show, and it's still the case here this week. With even this morning, they literally seized the tanker, and yet it couldn't really budge the futures a little bit, but not very long. And the market kind of discounting everything they're seeing out there, apparently as saber rattling. And maybe you're right. Maybe they're underestimating the upside we could see. Certainly the skew out there reflecting that as well. Let's keep on rolling into equities. This is another report. When I saw this come out, Erik, I said, okay, I got to get Erik back on the show. If for no other reason than the title of your equities report here and your research, hearkening back to one of my favorite dearly departed programs, which is, of course, Game of Thrones. And the title of your report list, Erik, was If When Winter is Coming, what should you do for the market? So winter is coming, obviously alluding to the much feared recession downturn for the equity markets. You outlined some interesting scenarios that could cause the winter to come, not just the White Walkers, but other cool stuff. And then what investors, particularly in the equity space, could maybe be looking at as setups as a result. So walk us through, again, one of your well-named reports here, Erik.
Okay, yes. Well, I had to fight to get that name on it because we didn't want to be seen as being doom and gloom. We didn't want any headline saying CME Group says winter is coming.
Let me talk to whoever your editor is over there at CME. I'll pull some strings for you because that's a good one. You got to leave that one out.
Yes, but we did want to sort of warn people though that the tighter U.S. monetary policy, the Fed having raised rates 9 times and gotten the yield curve just extraordinarily flat, in fact, even really quite inverted on the 0 to 3 year, and then almost no slope from 3 to 10, is really going to take a lot of money out of the financial system. That plus, of course, the fact that the Fed is dramatically shrinking its balance sheet as a percentage of GDP by not really reinvesting a lot of the proceeds that come back in from bond sales. But anyway, this tighter U.S. monetary policy has the potential to send volatility higher across a whole range of different products. So the report itself focuses on the cycle of U.S. monetary policy versus equity market volatility. Now, let me tell you this very briefly. That same cycle exists with almost every single product that trades on the exchange. You can observe that cycle with treasury options, currency options, oil options. Gold works very well, silver, copper, as well as even agricultural goods like corn, wheat, and soy that you may not believe could ever be influenced by monetary policy. But basically, the theory is very simple. The theory is that when the Federal Reserve creates huge amounts of money, like it does when it wants the economy to recover from a recession, it creates a very steep yield curve, so it has really low short-term interest rates, and that pumps gigantic sums of money into the financial system. And so when that money comes into the financial system, essentially it makes it really easy for buyers to find sellers and sellers to find buyers. So anybody can come into those very liquid markets and execute a gigantic trade, and there will probably be people on the other side who are willing to take the other side of that trade. As a result of that, when you have very generous monetary policy like we had really from 2009 up until really up until the last year or so, you typically have declining and then very, very low levels of volatility. So volatility on a sort of long-term basis has been incredibly dormant in most of our markets. There are a few exceptions like oil, which has been knocked around by huge price moves. But if you look at agricultural goods, equities, U.S. treasuries, gold, etc., near record low implied volatilities across all of those asset classes for most of the last, say, 3, 4, 5, 6 years. But now that the Federal Reserve is taking money back out of the system by raising rates, inverting the yield curve, doing essentially a reverse QE by shrinking their balance sheet, the risk is that we are about to see a tremendous rise in volatility. And if that rise in volatility plays out as I think it will probably look sort of like the late 1990s and early 2000s, in which the VIX essentially doubled from 93 to 96 after the very generous monetary accommodation of the early 1990s. The VIX averaged like 13%. After the Fed raised rates in 1994, the VIX slowly began rising and then really exploded towards the end of that decade. And essentially doubled. The VIX was now trading at like 23, 24% implied volatility on average from 97 to 03, which is a long time. That was 6 years of very, very volatile markets. The VIX dipped again following the 2001 recession. The Fed, of course, slashed rates to 1%, steepened the yield curve. So we had very low volatility in 2004, 5, 6, and early 2007. But after the Federal Reserve did that big rate hike cycle from 04 to 06, the markets had one calm year, and then volatility just erupted, as I'm sure everybody remembers, in late 2007 and into 2008 and early 2009. So now we've essentially repeated that cycle again. Fed dramatically eased policy, putting rates at zero for years. Volatility went down to very low levels across all of our products, or almost all of our products. But now that the Fed is raising rates, my fear for investors is that they are too complacent in equities, but across a huge range of asset classes. And what we started to see in equities in particular in the last 18 months is a slow step up in volatility. So every time the U.S. stock market rises up to hit a new record high, the VIX falls, but it doesn't fall as low as it had previously. So now in the VIX, we're starting to see a very consistent pattern of rising lows. which was something we saw in 2007 and something that we saw starting in the sort of very late 1990s before we got into that big bear market from 2000 to 2002. But I would add one thing. We said in that report's title, if when winter is coming, there is uncertainty. This is not a guarantee we're going to have a volatility explosion. As I said, the Federal Reserve is cutting interest rates now. If the Federal Reserve cuts interest rates quite a lot, they may return us to that very low volatility environment and could extend that low vol environment into the 2020s. But it's really up to them to see how deeply they cut. Because I think they're going to have to cut quite a lot to re-steepen the yield curve and to sort of put money back into the markets.
Well, before we keep rolling, since your title is so apt there, winter is coming. I have to know, Eric, yay or nay on the final season of Game of Thrones and how they wrapped it up in general. Were you a fan? Were you not a fan? How did your thumbs up, thumbs down? How did you fall, sir?
I fell somewhere in the middle. I didn't think it was a total disaster. They had to end it somehow. But I thought it was kind of a little choppy and fast. But, when you take liquidity out of markets, just like when you take liquidity out of a show by reducing 10 episode season into 6, choppy is usually what you get.
I like it. See, only you could bring Game of Thrones back to liquidity in the marketplace. There, an apt analogy, sir. You're pulling all those episodes out. You're right, getting a little thin, a little choppy as a result. That's probably as apt of a description as any I've heard for the final season out there. Let's do a real quick rundown here of what we're seeing in equities. I know you have a lot more research. So what happens when we don't have you on for like 6 months, Eric, because the backlog of research that you've got to talk about, it gets pretty extensive. Looking here on the old equity space, like you mentioned, on the volatility front, our old friend VIX taking a bit of a break, a breather coming in here, but still up from last show. Last show, it was far south of where it is right now, about a handle and a half lower. Actually, it's given up some of that. Coming into Showtime was about 14 and a quarter. It's given up a lot of that now, bound to about 13 and a half, which puts it about 3/4 of a point higher than where it was this time last week. So we saw vol kind of coming up a little bit today, then it's kind of settling out as we're seeing kind of a bit of a mixed bag out there on the street again. A volatility, aka the VVIX, also pretty much unched from where it was this time last week, right around 86.5, 87, which is pretty much exactly where it was. And then our old friend Russell VIX, a.k.a. RVX, up slightly, up about half a handle. So come into Showtime, that spread had come in quite a bit. It came in by more than a point. It was about 3.5 or close to it last show. This show at about 2.15. So that's come in quite a bit between the Russell and the VIX. And we know from past experience, of past prologue, whenever that spread tends to tighten dramatically or widen, interesting things are afoot out there between the small caps and the large caps. So maybe worth taking a gander out there and looking at all of that as well. But before we roll out of equities, Eric, you've done some other interesting research. Obviously, the select sectors are a hot area over there, lighting up the tape, in addition to, of course, the micros. I'm looking forward to your micro research, Eric, because those products are blowing the doors off of it as well. But the equity select sector is kind of something that's hot and heavy over there in CME land right now. You did some interesting research, because everyone knows the concept. They've heard of different select sectors. Oh, I want utilities. I want this, and this will give that. But I don't think anyone really does the legwork to dig into what really drives, let's say, utilities versus energies versus technology. So maybe, obviously it's a dense report. We don't have to go through all of it, but maybe give us a quick snapshot of some of your interesting findings and maybe some of the correlations between those different sectors.
Yeah, so first of all, the correlations between the sectors are really interesting. Usually in the early stages of a bull market, those correlations are very, very high. Everything goes up together. But as the bull market wears on, the correlations often break down, which is kind of what we've seen, from 2009 to 2014, pretty much all the sectors went up, which actually makes them a little less interesting to trade because, if everything's going up at the same pace, this industry versus that industry doesn't matter so much. But since 2014, we've just seen massive divergence. So essentially we have a market that's being led in the last 5 years by three sectors: by technology, consumer discretionary, and by, I can't remember even what the other one was, trying to think what it was, and healthcare. Healthcare is the other one. And so those three sectors have been the leaders, and you just have some tremendous laggers like communication services, utilities. Those stocks have just been nowhere. So the divergence between these sectors is really interesting, and they do have strong fundamental drivers. And so the drivers of those tend to relate to things like oil prices, the price of copper, which respectively are huge drivers, obviously, of energy and material stocks, and then interest rates. Interest rates are enormous drivers of these different markets. In particular, certain interest-sensitive sectors like utilities and real estate tend to benefit from lower interest rates as well as flatter yield curves. Whereas other sectors like bank stocks, it tends to be the opposite. They like higher interest rates and steeper yield curves. And then lastly, the last factor we really look at in the report is volatility. When you have volatility spikes, generally speaking, stocks go down, but they don't all go down at the same pace. So in a huge vol spike, some of the more stable sectors like utilities tend to be outperformers, whereas some of the maybe more overpriced or highly valued sectors like technology have recently been doing extremely badly on days in which we have a strong rise in the VIX. So that's something to think about for anybody who's looking at equity sectors. If you're a big portfolio manager, for example, and you have all the different sectors present in your portfolio, and you're worried about a rising volatility environment that the Fed's monetary policy might produce. In a rising volatility environment, some of these really underperforming sectors like communication services and utilities that have been totally ignored but pay stable dividends could be big outperformers, or some of the hot stocks like technologies could find themselves in trouble.
Yeah, speaking of stocks, it's been an interesting bit of a rebound here today. We started off the day, most of the major indices off about 1/3%, and now as we're coming at showtime, I guess, Eric, you're talking them up here. All of them are pretty much well into the green, with NASDAQ up about 1/3%, S&P similar levels, Dow a bit of the laggard, only up about 1/10%. So pretty much reversing themselves completely from where they were earlier in the session, hence that erosion out there in equity volatility. As a result, let's keep on rolling into another area we like to talk about here on the show. The shiny stuff, a.k.a. gold, an interesting one, of course. The recent tumult's given a little bit of a lift to gold. It's back well north of the 1,400 handle, 1,438. Coming into showtime, up about 26.5 handles, nearly 2% on the week. Of course, vol to the upside, and that's what we're seeing right now. Vol up pretty much across the board as a result of this recent move here in gold. So the concern, the bias, call it what you will, still up to the upside here in gold land. Eric, you've had some interesting research, again, that will they, won't they dance between us and China on the trade war front has had impact across a broad spectrum of complexes. I think if you have time, we'll get to the ags and soy in a little bit, but gold, obviously one that's feeling the heat from the trade war pretty directly. And you did some interesting analysis over there comparing gold obviously from a U.S. dollar denominated perspective, which is how most of our audience views it, but also from a Chinese perspective and denominated in their currency. And you had some interesting findings as a result. Why don't you break it down for us, Eric, what you found, the impact of the trade war from between U.S. and Chinese perspectives?
Yeah, so if you're in China and you're worried about higher U.S. tariffs degrading the value of your currency, then gold is a potential way to hedge your risk. So essentially, when the U.S. put a 10% tariff on China about 15 months ago in May of last year, that 10% tariff, within a few months, the Chinese currency fell 9%. And so if you were in gold and if you were sort of a renminbi-based investor and you were in gold, you made whatever the dollar investor made plus 9% from your own currency perspective. And so when the U.S. threatened to put that tariff up from 10% to 25%, the currency in China fell another 4% versus the U.S. dollar. And so essentially, the currency in China is now having a very different correlation with gold than it had in the past. And so, generally speaking, a stronger dollar is really bad news for gold, and a weaker dollar is good news. And it used to be that the renminbi followed the dollar pretty much in lockstep. It would have some variation, but not a lot. But now you're starting to see more and more divergence between those currencies. So now when the renminbi weakens, it tends to lead to higher gold prices, and that may be because Chinese investors are rushing in to buy as a hedge in case U.S. tariffs damage the value of their currency.
Yeah, a lot to unpack here. Looking at the gold markets here again. You check that one out for yourself, listeners. It's called Gold Impact from U.S. and Chinese Policies. One of your more straightforward titles. I don't see an allusion to a fantasy series or any sort of impending apocalypse anywhere in that title, Eric.
Well, I think that I just think that I hope gold investors fare better than Daenerys Targaryen's brother in that episode, I think called Crown of Gold.
Yes.
That was a rather unfortunate way to end.
Right. Hey, a dragon can't die from fire. We learned that in that episode. So fascinating stuff there. I guess they can't all be crazy titles here. But let's go on to, I mentioned the ags, in particular the beans. Soybeans, as much as we talk gold, but soybeans really are the literal ground zero for the trade war. That's where we've seen the most pronounced impact as a result of the tariffs and the sanctions and China pulling away. China, of course, the biggest consumer of our exports when it comes to soybeans, and that's been pretty much where we've seen the greatest impact as a result of this ongoing battle, saber-rattling, call it what you will, between us and China on the trade war front. Coming into showtime, we're seeing the beans off 30 handles this week, so another down week for soybeans. Of course, there's been a lot of domestic things weighing on supply as well here, in addition to things like, of course, the rain and preventing planting. So it's been a kind of a 1-2-3 punch for farmers here in the U.S. over the last 6 months or so. And the beans showing that off 30 handles, 3.5% roughly. The vol also off a bit, which is kind of interesting given the fact that we're seeing a pretty pronounced move out there in the beans here this week. And coming into showtime here, we're seeing, looks like it's the AUG contract doing the lion's share of the paper, 36% of the volume going up here in the AUG. But Eric, you have another interesting report out here, again, kind of detailing this ongoing battle between us and China. And of course, Brazil a factor in there as well, because Brazil, the alternative for soybeans. If China's not getting them from us, chances are they're probably getting them from Brazil. And you kind of broke down some of the nuances of that beans market, including the use cases, the oil, all the different uses, and also maybe some of the interesting nuances in terms of how the oil works, how it's more expensive than the meal, and some of the interesting things people who maybe don't watch the ags on a day-to-day basis maybe aren't familiar with. So maybe break down this one, entitled, listeners, if you want to go read it for yourself, China, Brazil, and the soybean crush. Break it all down for us, Eric.
Yeah, so soybeans, when you think about it, it's really three products. There's the soybean itself, and then there's the two derivatives of it, which is the meal, the protein, and the oil, which is the vegetable fat. And as it turns out, the oil is actually what was actually the most highly valued part of the soybean in terms of price. I think, on a pound-for-pound basis, it trades at about 2 to 3 times the price of the meal, which isn't to denigrate the meal. The meal is used to feed gigantic numbers of farm animals around the world and humans as well. Your tofu is made in part out of soybean meal, but the real value of it is in the oil, and so the oil is very, very closely connected to two things: to first the state of the Chinese economy, and secondly to the value of the Brazilian real. And so you mentioned Brazil is the alternative. Well, Brazil, in some ways, is even more than an alternative. It's now the world's biggest producer of soybeans. It has surpassed the United States. And it is also by far the world's biggest exporter of soybeans. And so the price of soybeans is pretty closely connected to the value of the Brazilian real. But the price of soybean oil is extremely closely connected to the value of the real. They move almost in lockstep. Soybean meal, on the other hand, is much less connected. And so I think what's basically happening here is that when the Chinese economy accelerates, what's going on is that they buy more energy and metals. Some of that is coming from Brazil. Brazil, in addition to being a huge soybean exporter, is the world's second biggest exporter of iron ore. Almost all of that goes to China. And Brazil exports tremendous numbers of other commodities. So when China's economy starts growing a bit faster, the Brazilian real tends to rally, and that causes the price of soybean oil to rise because Brazil's farmers essentially set the global marginal cost of production. And so as soybean oil prices rise, that incentivizes the planting of more soybeans around the world, which eventually causes a rise in soybean production. So it's just fine for oil. Oil's priced fine. But soybean meal, which is sort of the poor cousin in this whole relationship, also sees a rise in supply, but doesn't see a similar rise in demand. So soybean oil and soybean meal prices sometimes move opposite one another. And you see that relationship play out in the options market too. Essentially for soybean oil, option traders tend to be pretty good at determining the direction. So in other words, when they see a positive upside skew, usually soybean oil prices rally, and when it's a negative skew, often they sell off. But the soybean meal works the opposite way. So there's a lot of very, very interesting relationships that go on there as a result of the crush spread and the very, very different use cases for oil versus meal, and they're very different responses to what's happening in China as well as to what's happening in Brazil.
We could spend a lot of time, and we have in the past, just going into some of those nuances. But again, we got to keep rolling. There's so much here to talk about. I wanted to get on crypto too, but we do have a whole program for that. So Erik, we're kind of coming up against it here. But there are any other, recent product complexes that you've been breaking down or analyzing that you think may interest our audience? Maybe you have some little secret pockets of research here that you want to get a chance to talk about on the show. Now is the time, sir. What is on your radar we haven't had a chance to hit on yet?
Well, yeah, I think one thing that's really interesting is we're in the very, very early stages, I think, of an upturn in volatility. So we talked about how the VIX is stepping higher, but you're now starting to see that upturn in volatility happen in U.S. Treasury options and gold options. All of these things are coming off their lows. You're seeing it in the agricultural complex as well. So I think that tighter Federal Reserve monetary policy we're starting to see the first signs of it impacting markets. And so we're seeing a lot of markets turning the corner and just, I think, stepping towards the exits of this extremely low volatility environment. So I think that's maybe the most significant thing for any option market traders to think about. Another thing I think is kind of interesting is that gold options right now have a very, very positive skew. The out-of-the-money calls are really expensive compared to the out-of-the-money puts. If history is any guide, that may be an indication that the gold rally we've seen recently may take a little bit of a pause. That's not to say I'm bearish on gold. I think there's a strong case that gold could be a great investment over, say, the next decade or so, especially if I'm right about thinking the U.S. dollar is about to become a weak currency. A weak U.S. dollar is often very bullish for gold, but it may be an indication in the next month or two, maybe gold prices will take a little bit of a pause to the upside.
All right, Erik. Well, you guys are cranking away quite a bit. I don't envy your production schedule. People say they don't envy mine here because we do a lot of shows here. We do, but you guys do a lot of very lengthy research reports over there as well. Hopefully, we gave you a nice overview of some of the recent research Erik and, of course, Blue and the rest of the team have been working on over there in CME land. You guys can find it for yourself. It's pretty easy to find. They don't really bury it. Erik, it must make you happy that they put yours and Blue's research so front and center on the website. You guys are pretty much the first thing you see on CME.com.
We're very happy here. We love this place.
So yeah, CMEgroup.com. If you go there, you'll see it for yourself. It's pretty much right there on the homepage there. If you want to dig deep into a little bit more, click on the Economic Research Reports tab, and they'll take you to all of it, including this little thing they do over there called Off the Charts. What is that, Erik? Catch us up on that, even though it is indeed a competing podcast that is not on my network.
Well, so yeah, Off the Charts is basically our own podcast, but it's not specifically focused on options. Sometimes we talk about options, but it talks about a huge range of subjects from macroeconomics to economic data, to the sort of general state of the various markets. And occasionally it focuses on options as well, which is why it's not really a competitor for TWIFO. It's a complement.
I'm giving you a hard time. The more the merrier as far as I'm concerned here in the old space. You, of course, can find that over there at CMEgroup.com. We have to get you, I enjoy beaming you in, but we'll have to get you back in the studio. Any trips scheduled back to the U.S. anytime soon, sir?
Actually, I will be in California twice next month. very, very briefly. But it's on my way to Australia. I decided to go the long way there from London, so I could have a couple stopovers, one in San Francisco and the other in L.A. But no, I'm actually not heading back to the U.S. For business for a little bit here. But if I do, I'll be thrilled to see you in studio.
I think the last time you were in town, you actually were in Chicago, but for some reason, we still had to beam you in, even though you were pretty much across the street. So we lost out on that in-person magnetism, but we'll hopefully get it again sometime soon. Meanwhile, of course, check out Eric and Blue and the rest of the team's research over there at CMEgroup.com. While you're at it, CMEgroup.com/TWIFO to play with their reports. And if you're looking at the reports, check out what our friend Nick and the crew over there at QuickStrike have to offer at bantix.com, BANTIX.com, or indeed at QuickStrike, QUIKSTRIKE.net is the place to go to kick the tires and light the fires. Our buddy Sean is off gallivanting, spreading the gospel about all things Russell options and futures. So check it out for yourself in the interim. FTSE, FTSERussell.com is the place to go. Give him a follow on Twitter while you're at it as well, at FTSE Russell. A lot of great data and analysis coming out from them on active versus passive investing and volatility premiums and harvesting and the Russell 2000. All kinds of good stuff. If you want to get updated in between shows, that's the place to go. And on behalf of Eric and our friends over there at QuickStrike and indeed Russell, and FTSE Russell, I should say, and indeed myself, I want to thank all of you for downloading, streaming, and subscribing, and of course sending in such great questions. Didn't get to them today because we had so much research to cover. We'll get back to them next week, and we'll see you back here next week for more of This Week in Futures Options.
This Week in Futures Options is brought to you by QuickStrike, options pricing and analysis software. QuickStrike offers powerful and flexible options analysis and pricing tools via an easy-to-use web-based interface. View prices on outright options or spreads with comprehensive page-level analysis controls. Build trades, manage risk, or explore historical volatility. QuickStrike has you covered with market data reports ranging from open interest to the term structure of volatility. QuickStrike is the perfect addition to your trading toolkit. Learn more about QuickStrike at bantix.com. That's BANTIX.com. And don't forget to follow us on Twitter at QuickStrike1. That's QUIKSTRIKE1. This Week in Futures Options is also brought to you by CME Group, the world's leading and most diverse futures and options exchange. CME Group's markets help individuals and businesses around the world manage risks and seize opportunities. CME Group offers the deepest and most liquid options on futures across all asset classes, including interest rates, equity indexes, foreign exchange, energy, agriculture, and metals. For more information and educational resources about futures options at CME Group, visit cmeGroup.com/options. This Week in Futures Options is also brought to you by FTSE Russell, a leading global provider of benchmarks, analytics, and data solutions. Investors in the U.S. and around the world are using FTSE Russell indexes to benchmark their investment performance and create investment funds, ETFs, structured products, and index-based derivatives. Many Options Insider Radio Network listeners will be familiar with the Russell 2000 Index. Russell 2000 futures and options are currently trading on the Chicago Board Options Exchange and CME Group. For more information, please visit FTSERussell.com, CBOE.com, and CMEGroup.com. This broadcast is intended for informational and educational purposes only and does not constitute trading advice or the solicitation of purchases or sale of any futures or options. The rulebook of the applicable exchange should be consulted as the authoritative source on all current contract specifications. You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions@theoptionsinsider.com.